Happy Sunday, everyone, and welcome to the Macro Sunday podcast. I'm Andreas Steno, founder and CEO of Steno Research, and almost as per usual, I'm joined by you, Mikkel Rosenvold. Welcome to the show.
Thanks a lot.
You're a partner here in Steno Research, but also the driving force behind our geopolitics offering. And we've had a pretty crazy week across the board, with loads of trends going in the direction that we actually want them to, at least if our portfolio is designed to earn money, and it is obviously. Therefore, as a broad disclaimer before we get going, we always intend on being as actionable as possible in this podcast and this show. So the broad disclaimer, as per usual, is that our trade ideas might be...
Sometimes maybe good, sometimes maybe shit.
Good old Gennaro Gattuso. Mikkel, this is the independent macro podcast out there. And if our listeners want to find out more about our geopolitical offering and our macroeconomic and financial offering, they can actually use the Macro 30 code to get 30% off their subscription at stenoresearch.com. And Mikkel, we have three main discussion points today during the show. First of all, Europe. We've been pretty vocal in our bets against our own neck of the woods here in Northern Europe. Northern Europe has been the worst performing part of the Union. The big question now, Mikkel, is whether there is any juice left in this view, because it is slowly but surely becoming a consensus worldwide that Europe is not doing well.
Absolutely.
So what's your impression of that? I mean, even in the US and Asia, they get the feeling now that Europe is not doing well.
Absolutely. I mean, the headline perhaps for the Northern Europe is always going to be Germany, and that story is going really wide now. I think a lot of it is driven in narrative terms by the automotive industry.
Yes.
That's always the symbol of the German industry, but we have the same some of the same issues in Sweden as well. Here in Denmark, we are held up by pharmaceuticals, but not much else than that, to be perfectly honest. So that's pretty much where we're at.
Yeah. This week, Mikkel, we received the monthly survey from Bank of America, the fund manager survey, where they ask fund managers for the most recent trends in their positioning. And it is safe to say now that betting against Europe is sort of a consensus view, especially betting against Germany is a consensus view. It is also a consensus view to bet against the UK. They have a truckload of issues related to everything from Brexit to energy. But it is still not, and I said the key word here, it is still not a consensus to bet on higher energy prices.
No.
So this question of energy will be relevant for Europe again this winter, will it not? Yeah.
Absolutely. I mean, I think we've discussed this in the past as well. The gas storages seem to be pretty well filled up. So depending on how harsh a winter we're going to get, we should have enough gas. But that doesn't mean that prices aren't going to go up. We had a look at some of the wind auctions as well that's been taking place in Germany and Great Britain, and a lot of the future energy grid is obviously going to be formed by windmills, and those new projects, especially at sea, they're just not holding up at the moment in a high wind environment. So that's a major issue. That's a little bit more long term. I'll give you that. But already this winter we could see higher energy prices and trends towards that.
Yeah. So if we look at the energy situation right now in Europe. This target of 90% filled up storages ahead of 1st of November will be reached easily. In many countries, it's already within spitting distance. And therefore, it is not necessarily an issue in terms of supply this winter.
No.
A 90% full storage in Europe leaves roughly 2.5 to 3 months of leeway, even in the left-hand tail scenarios of a harsh winter and really bad supply. But the issue here is that obviously markets will start to become forward-looking from, say, 1st of October, mid-October and onwards, in relation to how you handle the next heating season and the preceding fill-up of storages ahead of it. I'm of the view that with 34% less natural gas reaching European territories on a daily basis, that we still need a winter ahead of us with very low demand to not have a situation of extreme imbalances between supply and demand. The consensus out there among energy economists and the European Energy Authority is essentially that we should expect a demand drop of 25% in natural gas relative to the pre-invasion base case. And I can guarantee you, and you can still see it in German industrial production numbers, that if you have a 25% demand destruction in energy-intensive industrial units, it essentially means that you have no growth.
Absolutely.
Energy is
That's
life.
a recession right there.
Yeah, it is. And it runs through the veins of right about every industrial corner of the economy. So my point here is that should Germany surprise just a tad to the upside of this very gloomy industrial outlook, should China surprise just a tad to the upside in the industrial outlook, then prices will accelerate, because there is, even before we discount a positive surprise to the industrial outlook, if it happens, there is already an undersupply, and it will only get worse in such a situation. So the only reason why we're easily available of reaching that 90% storage capacity ahead of timing is that we have such a warm winter last year that we started filling up gas storages from extremely high levels. I'm not a forecaster of weather. You neither, Mikkel.
No.
So that's obviously the dark horse here. But I mean, the underlying skew here is still towards a deficit in natural gas markets in Europe. And the question is, therefore, even should Germany positively surprise from an economic perspective, will energy prices not wreak havoc with that view anyway, then? That is essentially my base case right now. Even if Europe surprises positively from the very gloomy outlook that everyone agrees upon, then energy prices will start wreaking havoc with everything from trade flows to industrial activity into 24 again in Europe. Yeah. So we're damned if we do, we're damned if we don't, or whatever it's called, right?
Absolutely. And what I'm looking at is also if we see oil prices getting close to $100 per barrel or even higher, then the initial reaction in European capitals will be, then a lot of our renewable projects, a lot of our electrification projects will suddenly start to make sense again, even though we're in a high-rent environment. But is that fast enough? Can we get enough of that completed by next winter to reduce our reliance on natural gas? I'm a bit skeptical of that.
Yeah. We had an interest rate hike from the ECB amidst all of this. Yeah. We thankfully sniffed that hike out early. And we also got it right that the euro would actually sell off on the news that the European Central Bank intended on hiking interest rates even further. That's quite interesting to me. You could read this as a sign that markets now find the ECB to be almost overdoing things. You could also view it as a sign that the market basically took the ECB at face value in the press release. They have a paragraph suggesting that if you keep rates steady at this level for a prolonged period of time, it will bring inflation back to target. That is central bank speech for pause. They just write it in 3 paragraphs instead of writing it explicitly. So I think the European Central Bank, and that's my reading here, is very close to pausing, mainly due to the growth prospects around Germany, France, etc., the core countries of the Union. You could still argue that growth is actually doing pretty okay lives in Italy, Spain, Greece.
South of the Alps, yeah.
But that's the interesting question now, because if you look a step beneath the surface in terms of positioning, in terms of views, it's clear that a lot of money managers still hold the view that Southern Europe is doing fine. And I guess the reason is that the service economy, everything related to leisure, hospitality, traveling, all that stuff, has performed like crazy since we've been allowed outside again. On the receiving end of those inflows, you have Italy, Spain, Greece, those classic tourism economies, right? And my take right now is that this is the exact part of the economy that looks the most fragile relative to expectations. So will next season's traveling patterns be as strong? I doubt it. If we continue along the way that we've been going lately. And therefore, I guess Southern Europe is the next shoe to drop from an economic perspective in Europe. And that is not the consensus. If you look at the credit survey from the European Central Bank, Mikkel, Italy scoring worst on all parameters now. If you look at actual credit data, business lending, we have Spain and Italy below trends from France, Germany, etc. So on forward-looking gauges related to the money growth, related to the credit growth, Southern Europe is actually starting to look abysmal.
Yes.
It's just not penciled into expectations yet.
No, and I mean, if you look ahead at the coming holiday season, obviously that's almost a year away, the main holiday season. But then you're basically betting on, if you're betting on the Southern Euro economies, you're basically betting on that the Northern European countries, who usually are the ones traveling to the south, that we are going to be spending a larger amount of our disposable income on traveling because our purchasing power has been reduced.
Yeah.
Travel costs have gone up enormously, especially with higher oil prices. They will go up even further. Plane, train, etc. So you're basically betting on that we're willing to spend larger amounts of our disposable income on travel. And that might be the case. It has been the case probably since the lockdown, but I'm not so sure about that. We are going to see layoffs in northern European countries, and that is going to have an effect on people's willingness to go to Mallorca and Rhodes and whatnot.
So, Mikkel, this leads me to the second discussion of the week, which is a discussion on the labor market and like household psychology post the pandemic. I saw a clip earlier this week on Twitter with the Australian real estate leader, Tim Gurner, I think his name is.
Went viral.
Yeah. He's earlier suggested that students should eat a load more avocado toasts for some reason. He's called the avocado man in Australia. I didn't know that.
Probably true.
But he's very vocal in this clip that layoffs are simply needed now. So let's listen to Tim here and get back to the discussion on the labor market.
I think the problem that we've had is that we have people decided they didn't really want to work so much anymore through COVID, and that has had a massive issue on productivity. Tradies have definitely pulled back on productivity. They have been paid a lot to do not too much in the last few years, and we need to see that change. We need to see unemployment rise. Unemployment has to jump 40-50% in my view. We need to see pain in the economy. We need to remind people that they work for the employer, not the other way around. I mean, there's been a systematic change where employees feel the employer is extremely lucky to have them, as opposed to the other way around. So it's a dynamic that has to change. We've got to kill that attitude, and that has to come through hurting the economy, which is what the whole global, the world is trying to do. The governments around the world are trying to increase unemployment to get that to some sort of normality. And we're seeing it. I think every employer now is seeing it. I mean, there is definitely massive layoffs going off. People might not be talking about it, but people are definitely laying people off, and we're starting to see less arrogance in the employment market, and that has to continue because that will cascade across the cost balance.
He's not exactly trying to find new friends here.
Absolutely not. I'll say one thing.
Yes.
One thing I learned as a politics major is that there's a huge difference between 50% and 50 percentage points.
Yeah, sure.
I'm not quite sure which he means. Actually, it could be both. I'm not sure if it means that half the workforce needs to be laid off, but I wouldn't rule it out completely. Anyway,
an increase of 50% would be, I don't know, a couple of percentage points. So
exactly,
that's
exactly.
Just to put it on paper, so to speak.
Yeah.
But Mikkel, he's talking about a change of attitude. Employees asking for wage growth to an extent that is not feasible, etc. Do you think he's got a point here?
Yeah, to some extent, especially in Europe, perhaps we have seen some quite nice bargaining agreements for a lot of the employees, but still, it's in its core, it's a matter of supply and demand, and when we have so few hands basically to take over, it's the core discussion here, at least for Europe, if we look at that as the main focus today, is still the balance of how much labor are we going to do ourselves, how much labor are we going to import, because we have access to enormous amounts of cheap labor, and that could, who are definitely not arrogant about their employment. Australia could have too if they chose to open these doors. So that's an interesting analysis. I think what he's talking about here is kind of this. It's almost like a left-wing philosophy fused into some hardcore capitalism, because it sounds like he has this notion of that it has to hurt before it gets better, and that's sort of like the Greta Thunberg analogy that we have to degrowth a lot and then we can grow again. We have to purge ourselves of our decadent employment system, and that's kind of a weird philosophy in my mind. But yeah, great way to make a name for yourself, I guess.
And he didn't exactly receive a lot of high fives
No.
on Twitter after this clip went viral. But at least if you look at, current trends, both in Europe and in the US, you get to the conclusion that the amount of job openings is still relatively high compared to unemployment. In the US, we are running at 1.5-ish, the amount of job openings relative to the number of people unemployed. The number is a bit lower across Europe than that, but we're moving towards these things getting back in balance. We are fastly moving towards ratios of 1 and below on job openings relative to the amount of unemployed, and then he will get exactly what he's after, so to speak.
Absolutely.
But I want to highlight one thing today in relation to this, because one thing is, did the pandemic change everything in relation to the relationship between the employer and the employee? And I think, judging from both anecdotal evidence and actual evidence, so to speak, that there is a vast difference between how this changed the labor market in Europe compared to the US. I track cell phone activity downtown on a daily, more or less daily basis in many of the bigger cities in the US. In San Fran, we're roughly at index 25 to 30 of pre-pandemic levels, meaning that it's essentially a ghost town during the day compared to what it was. And we have similar trends in some of the other bigger cities in the US. Manhattan is not as worse off, but it's still clearly down relative to pre-pandemic index levels. And it goes to show that this trend of working from remote is just much, much more pronounced in the US than elsewhere.
Absolutely. Judging from social media, it seems that Americans are only going downtown to rob stores. That's kind of the impression that you get. No, anyway, absolutely. That's a trend. We're obviously seeing it in Europe, but not nearly to that extent. And we're still, and it probably has something to do with the cohesion of our markets, because in the US it's much easier to recruit and to work from home across state lines, because most of you have the same language. We don't have that in Europe here, so obviously we have a Spanish web developer, for instance. We can work with that, but it's there are still some transactional costs to that.
Yeah.
And I don't know, probably some cultural thing that we like to be in an office, we like to be together. We're not that mobile with our in the general sense of where we live. So there are probably some cultural sides to that. It could perhaps, this is me speculating, lead to the US job market being more vulnerable to being replaced by AI, because it's easier for an employer to replace an employee with an AI solution if he's never met that employee in person. I don't know. Could be.
Yeah, it's fair speculation. I'd say for now, one of the reasons why US housing markets have held up relative to a lot of other housing markets globally is, first of all, that the work from remote trend basically provides you with another incentive to stay in the current home, right? And if your home is your workplace, you're less inclined to sell, I'd say. That's one reason why the selling volume is very low still, and the amount of homes are readily available for sale is still very low. We have similar issues in Europe, but not to the same extent. And if you pair that with the third-year rate setup in the US with, obviously very long weighted duration in housing markets compared to Sweden, Germany, take the examples of the European economy, you just have an economy that can tolerate high interest rates for longer than Europe. Yeah. In my view.
That's a good point. And we're still waiting on the spillover effects from commercial real estate. I think a lot of companies are probably bound to some leases, but at some point we are going to see even worse crises in that sector as well, and that's going to hit Europe as well. Obviously, it might not even be that far away.
No, agreed, and we obviously have a few examples around our neck of the woods in Sweden on CRE as well. I think what I'm trying to say here is that both from a tactical but also from sort of a more structural perspective, I simply cannot get my head around why markets think that the Federal Reserve will outcut the ECB by miles next year. We've had a marginal move in our direction that this is completely wrong, but I still cannot envisage a scenario where the Fed cuts 4 times next year and the ECB is not really able to deliver half of that. Why is it also always so that markets automatically find the US to be the leader of everything?
Yeah.
I mean, we can get down a shithole in Europe without the US helping us. It is possible.
We're perfectly capable of that. Yeah.
It is possible. And you can just see China. I mean, they managed to go down that rabbit hole, so to speak, without anyone helping them.
Exactly.
They did that themselves.
And when you have some common characteristics, it might also be the case that some of the things we're seeing in Germany and Sweden might move over to the US at some point. It's possible.
Yeah, it just takes time, given the differences in rates markets and how mortgages are financed and all that stuff. So, yeah, I still sincerely struggle to see why the US economy should need 4 cuts when the European economy should not need the same 4 cuts or more. I struggle to see that. Speaking of China, I briefly mentioned that China managed to get down a rabbit hole, so to speak, without us forcing them or helping them or anything. And it seems like we're now in a mood of some sort of stabilization around China at weak levels. Essentially what we've been calling for over the past month or so. Everywhere we travel, Mikkel, and everywhere we talk to our sparring partners, it just seems like everyone has concluded that China is now in a 10, 20 year, 30 year structural mess and nothing can be done, right?
Yeah, and perhaps people are expecting Xi Jinping to come with this massive stimulus package or something. And as we talked about here, I don't think that's going to happen. You're going to see stuff on the local level. We're probably not even going to hear about it because we don't read Chinese or and the media is so disconnected. So don't expect any major waves with the magic wand. I mean, it's going to be solved on a local level, the central bank, and right now we're seeing stabilization. Yeah, absolutely.
And I would even argue that it is possible to find a few bright spots trend-wise in Asia. We talked about tourism as a driver of the southern European economy certainly outpacing the northern. What you could argue here is that Asia has not seen the full effects of a much, much later reopening of borders relative to Europe. Remember that Japan only relatively recently opened the borders truly. Remember that China only relatively recently opened the borders truly. It's been the same case for many Asian countries. So with a lag of, I don't know, a year or so, at least to what happened in the West. And if you look at tourism trends right now in Asia, they're moving up, while I kind of project the opposite to happen in Europe, given that the purchasing power of Northern Europeans wanes. And a country like Thailand, and I actually didn't know this until I checked the tourism data as preparation for this podcast and for one of our trade ideas. The biggest country in terms of arriving tourists in Thailand is China. I would have guessed that it would have been Germans or whatever, right? Yeah. But it's the Chinese visiting Thailand. And this is the first obvious travel season for them to actually visit Thailand. That's a very good point. Yeah. So I think we have a positive surprise in store on many of these developments related to travel flows in Asia still. And if we look at Thai tourism trends right now, they're roughly at index 60 of what they were at before the pandemic. If this development mirrors what happened in Europe, they will go above index 100, say over the next 6 to 12 months. This is one to watch, I think.
Yeah. We've already seen it in Macau, but that's probably the higher end, absolute higher end of Chinese tourists. So similar effects could definitely spill over to these countries. Very good point.
Yeah. So when I pair this all together from an actionable perspective, China stabilizing a bit at weak levels, admittedly, and probably also slightly increasing their manufacturing capacity and production pace now. that is on top of an already very, very tight energy supply. We haven't even touched upon both OPEC and the International Energy Authority releasing their reports this week suggesting that there's a deficit in the oil market. We were weeks, if not months, ahead of that story.
Absolutely.
And made a truckload of money on it. Now we're basically watching whether it's becoming the consensus to be long energy. It's not yet, as far as I'm concerned. But my point here is, if China's stabilizing at tad, it cannot get any worse than it is in the German industry. I think otherwise they close down. So, and if the U.S. manufacturing cycle is still bouncing off that stimulus from the Inflation Reduction Act, from the Chips and Science Act, and all that, we see a massive increase in construction finance in manufacturing. Then I struggle to see demand for energy going down.
Absolutely.
And as long as the supply is tight, that's a bad cocktail.
Absolutely. It basically means that energy prices are only going to go one way, and that's what we're betting on still. So that's I think that's a safe bet for now. We'll see.
And if you want a strong relative case in Asia, Japan is the worst off when energy prices are up because they import everything, especially after they close down nuclear capacity and all that stuff. So they import everything. And if you also buy my story that we will see an increase relative to current benchmarks in tourism in Asia, then you should probably buy one of the classic tourism economies and sell Japan on a relative bet in Asia. We'll be looking into how to precisely exploit that opportunity here at Steno Research in our strategic macro portfolio. So if you want live access to everything that we do, including our trade ideas, our live portfolios, our 15 to 20 research pieces on stuff like this, then go visit stenoresearch.com. Mikkel, isn't that the way to do it?
Absolutely. Go there.
We will provide you with the Macro 30 coupon code, so you can write Macro 30 when you go to the subscription link and get 30% off your subscription. I think we will leave it at that this week. We had fewer sound bites and clips than usual. I had actually prepared a few more, but I forgot to mention them.
We'll get back to that next week. No problem.
Yeah, we'll have a laugh next week with remember that it is Federal Reserve Week. Yeah. And as a cliffhanger, we have one of the greatest members of the committee. He just left the committee, but he will join us for the rundown of the FOMC meeting. And then we will also be joined by a client of ours, but also one of my favorite asset allocators. So that was a double cliffhanger. We will have two guests next week, and that is also the reason why we didn't have a guest this week, because I managed to book two guests next week. I thought I had booked the other one this week. Yeah. That is admittedly why we're only the two of us, Mikkel. But that's how it is sometimes.
It's a pleasure anyway.
I'm only human.
Absolutely. It was a pleasure.
So thank you very much for watching and listening to the Macro Sunday. As per usual, we'll be back exactly next Sunday, a week from now.